Olex Network 18, Mission Poshan, Bhavishya Roshan.
This evening, Network 18 learns that the centre is all set to announce a 10,000 crore rupee package for farmers. Remember, the last time we spoke to the Indian Sugar Mills Association, total dues to cane growers had already crossed about 20,000 crore rupees. Let's bring in Avinash Verma of ISMA, who's joining in now. Avinash, the centre has already doubled the sugar import duty to 100% and has scrapped export duty to check sliding domestic prices. It has reportedly also asked mills to export 2 million tons of sugar. What can we expect? And from what we are understanding, the 3 points that have come in: sugar duty, export duty to be made 0, import duty to be made 100% from current 50%, sugarcane farmers to be given 5.5 rupees per quintal. Is that enough to actually lead to a financial impact there?
If you really see all these packages, all these announcements that you just mentioned were announced sometime in February and March, and the 55 rupees per ton or 5.5 rupees per ton of cane payment to the farmers was announced sometime in the end of April.
Correct.
So almost somewhere 2 months have passed, somewhere 1.5 months have passed. But the problem of the sugar industry continues. The sugar prices continue to be almost about 7 to 8 rupees lower as compared to our cost of production. The cane price areas of farmers, as you mentioned, is now almost about 23,000 crore. So I don't think these measures have really helped the industry.
Yet. Avinash, the 1,560 crore rupees that had been announced in April, which is what we are talking about essentially, the 5.5 rupees per quintal, has that even remotely made an impact on that large cane arrears that we have right now?
See, the 1,560 crore announcement is connected to certain conditions that we have to fulfill.
Okay.
And all these conditions, like, for example, one condition says that we have to supply 80% of the ethanol indents given by the oil companies to us. And those ethanol indents will continue till the end of November 2018, which means obviously once we fulfill that, only then this money can come into the sugar industry. Secondly, they have put a condition which says that we have to fulfill the stock holding limit of February-March 2018.
Yeah.
Now, that is a retrospective condition. This announcement of 5.5 rupees came sometime in the end of April, but the condition is of February-March. Now, we can't go back and change the history which has already happened.
Correct.
So, because of that, I don't think much has really happened on this front.
So, Avinash, what you're saying is essentially, yes, perhaps there is a 10,000 crore rupee financial package in the making, but from the looks of it, what we see as being the characters of this, be it the import, be it the export, be it even the 5.5 rupees per quintal amount, by the looks of it, this will not really have much of a financial impact per se.
Not yet. Let's look forward
So what
to
according to you, Avinash, would be the areas? For instance, there are reports saying that the creation of a buffer stock of 3 million tons is being considered. They are likely to fix a minimum mill sale price of around 30 rupees per kg. These two areas, if they were to be brought in by the government, would that really make a substantial difference?
Yes, both these steps which are going to be taken, creation of 30 lakh tons of buffer stock, means that the carrying cost for 1 year will be borne by the government. And that means 30 lakh tons of sugar will be temporarily out of the market for 1 year. And therefore, the pressure on the sugar mills to sell and the pressure on the domestic prices may be less. The market sentiments might improve. Secondly, if they fix a minimum price of 30 rupees, it's certainly going to improve our returns, because currently mills are getting about 27.5 rupees or 28 rupees at the mill gate. So it's going to improve the revenue realization of the sugar industry. But if you ask me, is 30 rupees at the mill gate good? I don't think it is enough to take care of the 22,000 crore of areas, because 30 rupees does not allow us to cover the FRP of 290 rupees that the government wants us to pay to the farmers.
So Avinash, very quickly, wrap closing comments for you. What exactly is needed? 4 points that are needed to bring down that arrear of 20,000 crore rupees. And by how much would you want this amount to come down for farmers and mill owners to actually be in a comfortable position at this point?
First of all, the minimum price that the government is looking to fix, it should be around 35 rupees, which is our cost of production, which can support the FRP of 290 rupees per quintal of sugar cane. Secondly, all these problems is because of a surplus of around 70 lakh tons this year, and another expected surplus of around, again, another 70 lakh tons or more around that number next year. Therefore, the solution is to push out the sugar into the international market. the export prices are not good enough, the sugar industry will lose money. So if the government can help us by way of paying something, a part of the FRP to the farmers, a bigger number than 5.5 rupees per quintal, that will give us the strength to export more sugar into the international market. Thirdly, obviously, we need to find ways, which is a long-term solution, find ways to rationalize the sugarcane pricing issue. We can't continue like this. Year on year, we increase the sugarcane price, but the sugar price keep coming down. People are talking about A2 plus FL cost. We are paying twice the A2 plus FL cost already as sugarcane price, which means we are almost 50% more than any competing crop in the country. There has to be a rationalization on the sugarcane side. Fourthly, we have to increase our capacity on the ethanol production side so that we can divert some of the surplus sugar as soon as possible over the next couple of years. We can develop the capacity and reduce our sugar production.
Okay, fair enough, Avinash. Thank you for taking us through that very critical story. Of course, this is something that is likely to be brought into the cabinet. We need to wait and watch out to see what the elements will be of that reported 10,000 crore rupee package. So in the next 2 to 3 days, we should have some clarity on that. Thanks once again, Avinash, for joining in and giving us your perspective. But let's move on to the market action of the day. No respite for bulls as markets continue to tread lower, led by losses in Bank Nifty. The Nifty fell below its 10,650 mark, below its 20-day moving average. The Sensex managed to hold on to the 35,000 mark. Mid-cap mayhem clearly continuing there, with that index losing more than 200 points. Banks were the clear laggard of the day. All constituents of Bank Nifty ended in the red, while that index closed with cuts of a whopping 400 points, more than 400 points actually. Now, after fourth quarter earnings failed to light up the Wall Street, markets are treading with caution over a potential recovery. Two big brokerage houses have downgraded their earnings estimates for FY19. UBS has cut their FY19 projection by 3% and FY20 projection by 1%. Now, they expect Nifty earnings per share to grow at 20 to 21% in FY19. So, CLSA has cut its earnings estimate for FY19 by 3% and expects a 20% growth in earnings in FY19 and 17% growth in FY20. However, another leading advisor, Motilal Oswal, remains optimistic. They expect Nifty EPS to grow 27.4% in FY19 and 19.6% in the financial year FY20. So that's as far as the perspective on brokerage houses is concerned. But let's listen in to what market voices had to say on their perspective.
So, except for your public sector banks, I think earnings came, there were quite few bright spots. Automotive was very good. Your oil companies came out with good results. Private sector banks came out with good results. All the NBFCs, they gave good results. So, I think there were enough bright spots. Of course, the disappointment was coming from public sector banks, which probably could be a last stream of operation, and they could be in for a moderately to very good 18-19, the current year. That could be significant. That's the guidance you are getting. So let's see what happens. But I think the worst seems to be behind for those sectors also. So what is bringing down the earnings in aggregate, I think that will become one of the bright spots of the earnings growth. And metals, some of the metal companies have delivered wonderful results. So all in all, I think it's not a great quarter, but it gives a sense, it gives a sense that 18-19 should be a much better year.
For the last 5 to 7 years, like clockwork, every year the earnings are getting downgraded for the future years. At the beginning of the year, be it buy side or sell side, everyone has from, I would say, not just several years, I would say past couple of decades, everyone has a earnings growth somewhere around 15%.
More than
15 or more than 20, depending on, more than 15 depending on what the markets are doing. And as the year progresses, it comes to mid-single digits. So in a year where earnings are not downgraded, that would be a major surprise. I would say the magnitude of downgrades is what you have to look at now. The magnitudes of downgrade, in my sense, are coming down. And the earnings growth trajectory is improving.
I think if you look at the large companies, by and large, they have delivered what they expected to deliver. Probably a lot of the disappointments is in the smaller companies. We continue to expect an industrial revival, even though the PMI reading for April was a little bit on the softer side. So we are hoping that that's a blip, and we'll continue to move ahead with all the capex that's taking place at the end of the government. I think on the financials, the earnings growth story is intact, because I think if the NCLT process stays on track, I think the financials will be able to report the kind of earnings growth that the street is forecasting. So at this point in time, am I a little concerned on earnings? Maybe yes, but would I be willing to downgrade estimates right now? The answer is no.